In March 2026, driven by geopolitical tension, global oil prices experienced a sudden, record-breaking spike that completely disrupted energy markets. The surge was driven by a global supply contraction following significant geopolitical disruptions at Middle Eastern choke points, specifically around the Strait of Hormuz. Under these conditions, standard market logic dictates that an energy supermajor like ExxonMobil should be reporting its highest profits in years. Instead, the company's Q1 GAAP earnings collapsed to $4.2 billion, a sharp decline compared to the previous year. Momentum algorithms and headline-scanning trading desks immediately began shorting the stock, reacting to what appeared to be a massive operational miss. But those figures are incomplete. The company's true underlying non-GAAP earnings actually reached $8.8 billion for the quarter. This gap indicates that the market's initial reaction was based on a misunderstanding of the balance sheet, a discrepancy we can only resolve by auditing the specific financial mechanics hidden in the filing. This chart shows how that $4.6 billion gap is bridged. The primary driver is a $3.9 billion figure, labeled as an estimated timing effect. This $3.9 billion represents a mismatch between digital financial contracts and the actual movement of physical commodities. An additional $700 million in losses were categorized as identified items, which management also tied directly to the physical supply disruptions in the Middle East. On paper, the headline net income is dropping, but the loss is occurring well before the physical oil is actually sold to customers. This multi-billion-dollar paper loss is masking the cash-generating power of ExxonMobil's core assets, requiring a forensic look at the company's specific approach to hedging. ExxonMobil manages price risk by using short derivatives, which are digital contracts designed to protect the company if the price of crude oil drops. Crucially, without hedge accounting, their digital derivatives update continuously in real time. This creates a mark-to-market paper loss. When the market price of oil goes up, the value of the short contract goes down. The historic price spike in March triggered immediate and massive losses on these short positions across the entire portfolio. Corporate accounting rules require the company to record these losses against their net income the moment the quarter ends, even if they haven't sold any physical oil yet. Mark-to-market accounting forces ExxonMobil to declare this financial pain immediately, while the massive gains from record-high oil prices won't appear on the books until the future. While the digital derivatives show a loss, the physical crude oil is stranded in transit, caught in the regional Middle East crisis. Logistical bottlenecks mean that while paper prices are at record highs, many physical ships cannot reach their buyers to finalize the sales. This physical delay is governed by an accounting rule called LIFO, or last in, first out inventory accounting. Under LIFO rules, ExxonMobil cannot record the revenue from these high-priced barrels until the shipping bottlenecks clear and the delivery is complete. This creates a delay. The immediate derivative losses will be counterbalanced by a massive cash influx once those physical barrels finally reach their destination in the coming quarters. Moving past the accounting noise, we can see the actual state of the company's physical production. The Guyana Basin is currently the company's most important asset, a structurally advantaged, highly integrated, low-cost, high-volume production site. In the first quarter, Guyana set a record, producing 900,000 gross barrels of oil per day. This offshore volume is supported by domestic scale in the Permian Basin, providing a diverse and redundant supply chain. This high production volume is being delivered alongside significant, permanent reductions in base operating expenses. Management has achieved $15.6 billion in cumulative structural cost savings since 2019. Because the base operating costs are lower, every barrel of crude sold today captures significantly more profit than it did 5 years ago. When stripped of the derivative noise, Exxon's high-volume, low-cost assets generate cash flow that is largely insulated from these temporary accounting shocks. Management is using its internal cash flow to set a mathematical floor under the stock price. They are doing this through an aggressive $20 billion annual share buyback program. In Q1 alone, they spent $4.9 billion on buybacks. This reduces the number of shares available, helping to support the equity against the optical earnings miss. The company also maintains a debt-to-capital ratio of just 15.4%, making the balance sheet resistant to short-term credit market fluctuations. This capital structure weaponizes operational cash flow to put pressure on short sellers who are trading on superficial headline data. Even with this level of financial defense, the bull case for the LIFO lag depends on one specific geopolitical variable. The primary risk to this entire financial equation is a rapid, unexpected geopolitical de-escalation in the Middle East. If peace is established quickly, the high price premium on crude oil will likely disappear. If global prices drop before ExxonMobil can clear its shipping bottlenecks and deliver its stranded oil, the expected cash influx will never materialize. In that scenario, the derivative losses from Q1 would become permanent losses of value, rather than just a timing mismatch on the balance sheet. For investors, the real concern isn't the chaotic Q1 earnings report. It's the possibility that markets normalize faster than the tankers reach their ports.